I have 500 rupees and I want oranges and apples. Sir, for rupees 500, you can have an assorted fruit basket of a bit of every fruit.
That's exactly what an exchange-traded fund does. It gives you access to the whole basket when you choose an ETF. Aim to enjoy the fruits of your investment. Invest in ETF. Smart option choose karo. ETF karo. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi everyone and welcome to the second leg of our ETF webinars, and today we want to speak a little bit about uncovering the potential of active and passive investing. So last time we had spoken about how ETFs measure up individually, and today we want to talk a little bit about how this whole active and passive relationship works and whether or not both kinds of funds can live together in one portfolio. So joining me today, I have Sharif Mohan, CEO of Mirae Asset Investment Managers. I have Ashish Shankar, Deputy Managing Director at Motilal Oswal Private Wealth Management, and Mohit Kant, who's the co-founder and CEO of Money Fund. Gentlemen, thanks very much for joining me. And Swaroop, I'm going to begin with you because we've spoken extensively about the underperformance of actively managed funds, about how the passive investing is catching on a trend. Recently, I did a show, and the question was whether a 3 ETF portfolio is all that a person needs. Now, I thought it was radical, but a lot of people connected me saying that it's really not a radical thought. Do you think we're heading that way, or is there still scope for this active passive to work together? Do they really complement each other?
Sumana, thank you so much for that question. Yes, it is the question of the hour or the time. We are probably on that threshold where this question starts being questioned because the avenues of alpha obviously shrink. We are probably in that beginning of that discussion era, and with Ashish and Mohit being there, they'll probably be able to share more neutral data than I can. But from a question perspective, yes, what you were talking about or referring to a 3 ETF theory is probably the evolved status of that investor. At this moment, we are getting into that phase where most of the investments in India are on the active side, and due to shrinkage of alpha in one or two particular sides of the market, which is an eventuality, as I said, with the efficiencies in market going up, can come about. I definitely do agree, and as a result, active funds could find it difficult to outperform, or active fund managers will have to develop new ways of finding alpha going forward. In such cases, investors would start considering, of course, the advantage or the disadvantage of costs that are involved, and he or she would start evaluating to add low-cost passives to their portfolio that tracks the index, such as say the next Nifty 50 or the next 50. This is generally how passive investments start, and I do believe that we are on the threshold of that particular phase in India.
So Ashish, you're a neutral party. Which way of the divide are you standing on? Do you think that the future of ETFs, or do you think there's some sort of a mix or a relationship?
Yeah, so Mirae, we are going through a very, very interesting phase, and I think the West has already gone through this phase maybe 2-3 decades back. If you look at the US markets, it's very well discovered, and passive investing is almost accepted as a core way of investing your money into equities. In India, we've seen a series of regulatory changes which is made labeling of funds more effective now, where with the large cap, with the multi-cap, as well as the small and mid caps being defined very, very sharply. So my view is that going forward, at least in the well-discovered category of large cap, like Swaroop mentioned, the Nifty and next Nifty, it's going to be difficult for active managers to consistently outperform. Whereas there are other categories like focused categories or categories like multi-cap, fund managers do have much more flexibility. Of course, we will see what happens to this entire debate about multi-cap. We'll know shortly. But there, I think the fund managers have more flexibility to express their philosophy and to express their convictions. So I do believe that over time, passive will become a larger allocation in most client portfolios. However, I am in the camp that both can exist. I mean, it's like, a lot of people like to have simple food. Dal roti, sabzi is good for survival, but you also want a little bit of dessert on the side. You want a soup before you start your meal. So it also depends on customer preferences. So I do believe both will coexist, but the definition will become sharper for active. I mean, right now we see a lot of funds who I call, pardon me, to Swarup is there, index huggers. Where they try to mimic the index and try to do a little bit of value add to get that extra zing from the portfolio. I think that kind of investing is dead, and investors will clearly differentiate between the two. So the definition for active will become sharper, but passive will start enjoying a larger allocation in most client portfolios. That's my view, Sumera.
You know what my problem is, that as an investor, I don't care if my fund manager has a philosophy. It's very well, to have a philosophy, but if I'm not getting my returns, then I don't care if it's an index fund, as long as my portfolio works. But I take your point, and there is scope for it. I'm going to come back to it later. I want to complete this point about, what is the relationship. Moving for a long time, a lot of people say that, if you have an active portfolio that is underperforming, why don't people, add an ETF to sort of balance it? So how long will ETFs be carrying the cudgels of, just making up for it? Isn't it time, therefore, that they move to the forefront and become part of the portfolio?
So look, I think some historical perspective to this is perhaps that ETF started in US in around 1993. That was the first time a ETF fund came in. In India, it came in as late as around 2003. So the cycle obviously has a 10-year kind of a gap, right? But in US, if you see in August of 2019, the ETF industry has actually overtaken the active industry. So the passive allocation now is 50.1% and the active allocation is 49.9%. So gradually the cycle is moving globally, which means that more and more investors are moving towards index. Now, what ETFs also does technically is that they are like wolf packs, right? They weed out the low performing average fund managers every year who are high cost and who can't kind of chase index and kind of deliver outperformance over the index. So my take will be that over the course of next 10 years, and I think that's a fairly long time, I think gradually category by category, ETFs will start overtaking few fund managers who consistently underperform the market. So in large cap category, we've already seen that wave which is coming through, that lot of HNI investments and other investments are moving towards ETF and index funds as fund managers consistently underperform the index. But in other categories, as Ashish was rightly pointing out, which is multi-caps and perhaps mid and small caps, I think the wave will take some time to catch on. But the regulatory changes and other mixes, and given the structure of Indian markets, I think consistently delivering alpha has become kind of a mirage for fund managers. So my sense is in next 10 years, it will tilt completely towards ETFs in a large way.
Okay, so now let me come to this point of that ticking human brain, right? What Ashish referred to as the philosophy. Swaroop, you set aside the Nifty B, set aside the gold ETFs, etc. When you come to more specialized investing, like say pharma, IT, banks, do you think ETFs can really serve the need where every company requires particular analysis? The market share is so minimal, 0.4, 0.5%. Liquidity is hardly there. There aren't enough incentives for these people to get into it. Is it really worthwhile? Will they ever make it to the forefront?
See, Ashish sort of talked about the index and index hugging, and how that part will start becoming victims to the ETFs going forward. Similar is the case with, say, specific sectors or categories. As the efficiency or the transparency starts growing, it will become impossible for you to be the first fund manager to go and find a stock. Invariably, with such a transparent market, when you've thought that you are the first one to land up there, you will find another 10 guys sitting there also analyzing the stock. That is what we call of efficiencies increasing in the market. But what will come from the ETFs, and that's something which needs some regulatory changes from that side, the beta side of the ETFs will come into play. I have always, in my last 2-3 years of trying to understand the business, now I've come to this conclusion that there is a very intense active thought behind a lot of passive products. And that's something which has already unfolded in the evolved markets like the US and other parts of the world. We will see that coming in India in the times to come. But like I think both Ashish and Mohit are saying, it has to be a mix of both. Some parts which will fall prey to, say, the alpha generation could go to the core holding in the ETF form, while there will be inefficiencies in the market, which will give plenty of opportunity for active fund managers to come out and give alpha, right? Like we are debating ourselves whether, the ESG part should be, approached from us on the active side, or we just put a passive ESG fund. I mean, that's something which fund houses will debate within themselves, look at their core strength and come out with abilities to, either attempt beating it or just buying the market. Similarly, will be the case with the investor. The investor will try to beat the market with an active fund manager or just buy the market and be with the passive side. That's a very interesting time, and that's why I keep on saying the play of advisory now goes to a different level. The mix of the portfolio is more important than just one scheme.
Yeah, very well said, Swaroop, because, for the longest time, people were asking, should I buy an ETF? Now the conversation has moved to which ETF should I buy, right? So Ashish, if that is really the case, how about you set expectations right? How should this portfolio be constructed? What are the kind of, ETFs people should buy? And how to complement it to the passive, right? If you have, like, say, a Nifty bonds, what are the complementing active funds that go with it? Can you give us a little sense of how people can, logically work this out in their portfolio?
Right. So, Mira, interestingly, if you look at the construct of our market today, right, it's mainly held by promoters, FIIs. Retail participation is still very, very low. So I think what people should think about first is getting their allocation right. I mean, today, most investors are under allocated to equities as an asset class. This is very different from US as a developed market. So I think when you're getting adequately invested in this asset class called equities, you could say that I'm a big believer in simplicity. So I think you should start with 30 to 50% allocation in, let's say, passives for a first-time investor. You could take a mix of Nifty and next Nifty, and then remaining 50 to 70% of your portfolio, you can probably put money into time-tested multi-caps or maybe one or two small cap or mid-cap funds, which is where you're trying to generate a bit of alpha. So you keep it very, very simple. Over time, I think over 2, 3, 4, 5 years, you will yourself be able to judge what you're good at and what you're not good at.
Yeah, no, that makes sense at all. Keep it simple. And, I take your point also about this whole difference between whether you want, large cap exposure in your portfolio and how much you want mid and small cap, and therefore allocate accordingly. Mohit, in ETFs, does it, so suppose I want to go for, like, say, a IT ETF or, something like that. Does it matter what is the size of the ETF I'm choosing? I mean, is liquidity such a big constraint, or should it be a factor for an investor? And what is the kind of proportion that you're advising clients in terms of this, active passive mix?
Okay, so two parts to it. I think liquidity is by far the biggest determinant of an ETF. Just to give you a small example, Nifty Bees, which is the largest ETF in the country, has less than 1/100th of trading value of RIL stock, like a single stock. So it speaks volumes about the maturity of the market and the market. I think the liquidity factor will get adjusted, and the more APs come into the market and market participants come in, that factor will get adjusted. The second part is very interesting, which is what we are advising. So look, Sumera, what we have done is on the equity and the debt side, So there are few parts which can be very well addressed only by ETFs. So let's say commodity. So if you really want to buy gold, today there is no option but to go to a ETF or a gold fund, or maybe you do a sovereign gold bond, which can be an alternative. But commodity technically is the way, ETFs are the only ways to buy commodities, right? Unless you directly want to trade in futures and commodity exchanges and all those things, or you want to go physical. But that's the most efficient way. When it comes to commodity allocation, we advise ETFs, which is gold bonds or gold ETFs. When it comes to debt also, for conservative investors, we have actually adopted the route of going the Bharat bond, which is again a very, very conservative way of allocating debt investments. And I think as government agencies start to participate more through CPSCs and other things, even in the debt, on the debt side, the debt ETF industry will actually go out of proportion, and that will become the biggest chunk. So these two.
Okay, so now I want to take this point, since so many people have spoken about how on the large cap side, ETFs is the way to go. So now let me put a counter view to that. So for everybody who's watching, for our audience, I want to give you just a brief introduction into this person called Michael Burry. So he is the investor who had successfully predicted, or you can say recognized or saw it coming, the subprime crisis in the US, right? So he is the guy on whom the film The Big Short is made. You might want to watch it. And if you're still not impressed, let me tell you that, in 2008, when the whole world was collapsing and everything was coming apart, he and his firm made $800 million. So, just to set the context, he's that guy. And that guy now says that, ETFs and other index tracking products are leading to a bubble in passive investing, right? So basically, the theory is that too much money is now chasing too few stocks. And to set it in context, in the Indian market, only the top 100 companies by market cap are called large cap companies. So Swaroop, my first question to you, this was about a year ago that he said it. Do you see it unfolding that way, or is there a counter view to the counter view?
No, I mean, from a theory perspective, what he's talking about is clearly an overbought position, when you've bought more than you can sell, and that is when a bubble sort of forms. But from an Indian perspective, it's a little overblown, I would say. In India, active funds practically own the market from a mutual fund perspective. When you buy an index fund of the total, say, the stock market, you are literally buying the stock market in proportion to the shares held by all the active investors. That's what you're doing. If you sum up the collective holding of active managers, what you basically get is a market or a market cap weighted sort of index, right? Index fund managers are simply buying what the active investors have laid out for them. That is what index buying is in India. And in proportion, we still, and Mohit sort of laid down the figures of the proportion of the index. Yes, from the US perspective, the passive funds have grown, and this discussion can probably start in US. I mean, when you look at the US stock doubling from 3.3% of the total market, I mean, the holdings of US ETFs in 2002 to somewhere 6.8 in 2009, and now almost 15% of the public companies, you can start that discussion. Yeah, but if you look at this, I would counter by a Vanguard study which says that ETFs hold just 5% of global assets. So my counter would be, people should be worried about active markets, active managers by holding can crash the market someday, not passives yet.
Mohit, last word. The thing with India is jo dikta hai wo bikta hai, right? So distribution for mutual funds is so critical that, if you've got that right, whatever, any fund or category that you have can succeed. Do you see ETF being distributed as well as active funds? Is there enough margin in this product? And therefore, unless that is the case, how are people going to be incentivized to, even offer that as an option to clients?
So I think that's the tricky part, and that's where the market structure comes into play and the regulators come into play. To be honest, I think it's a very, very fair question. Without a proper distributor incentive or a value chain mechanism, I don't see the ETF industries growing as fast and thick as it did in US, but it will slowly catch up by virtue of its performance. Like, the performance will show up someday and people will realize what they are paying for. as alpha shrinks across the industry, I think participants will move towards that. But the distributor incentive structure is extremely poor out there. The ETFs actually run and thrive on low cost, which is 5 bips to 10 bips kind of an expense ratio. And they can't pay annual trail also. So, right. So there are many parts to it. The distributor incentive is massive actually, and that can't be done away with. So distributors will continue to go ahead with active choices. But I think performance will catch up over time, and it is for the regulator. Regulator has actually brought in a lot of things on the advisory piece where advisors can charge a fee around the portfolio which they advise on. And out there, I think a lot of advisors started wrapping up ETFs. So we as advisors actively promote ETFs to our clients because we charge an advisory fee. But I think that culture also will take some time in India. So it's a decade away, I would say. But yeah, slowly things will change.
All right, slowly but surely, right, snowballing into our living room. Swaroop, Ashish, Mohit, thanks very much for joining in, for giving your time to explaining this concept of active and passive, and how you can't deny that there is some bit of mix that is required. You can't do one without the other. Thanks very much to all of you for being part of this webinar.
Thank you.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.